Warren Buffett is 94 years old. He's seen every major economic crisis since the 1950s, the oil shocks, the stagflation of the 70s, the dot-com crash, the housing meltdown. And if you applied his investment principles to what's happening right now with Trump's tariff announcements, the warning would be crystal clear. Millions of Americans are about to watch their retirement accounts get destroyed, and most of them have no idea it's coming. 3 days ago, the stock market dropped 623 points in a single day. That's the biggest drop since August. The reason? Trump's team gave specific dates for when the tariffs start. January 20th, 2026. That's 38 days from now. And the stocks you own right now, Best Buy, Apple, Target, the car companies, they're all in the blast radius. Here's what's coming. 3 levels of tariffs. First, a 10% to 20% tax on everything we import from every country, no exceptions. Second, a massive 60% tax on anything from China. Third, an extra 25% to 100% tax on cars and car parts. This isn't a proposal anymore. This is locked in. The dates are set. The percentages are announced. And in the next 90 days, you're going to watch certain stocks lose 20%, 30%, maybe 40% of their value when the earnings reports come out and confirm what I'm about to show you. Now let me explain exactly how tariffs destroy a company's profits, because once you see the math, you'll understand why this is so devastating. Imagine you run a store, you buy a TV from China for $385, you sell it for $500, you make $115 profit. That's a 23% margin. That margin pays your rent, your employees, your electricity, everything. But on January 20th, when the 60% tariff hits, that same TV costs you $616 to buy. Now you've got 3 choices. Choice 1, keep selling it for $500, but now you're losing $116 on every TV. You go bankrupt. Choice 2, raise the price to $805 to keep your profit. But nobody's paying $805 for a TV that cost $500 last month. Sales collapse. You go bankrupt anyway. Choice 3. Try to move your factory to Vietnam or Mexico. That takes 2 years and costs hundreds of millions you don't have. 3 choices, all of them bad. And that's exactly what's about to happen to the companies in your 401k. Let me show you real examples with real numbers. Best Buy. You know Best Buy. The blue shirts, the Geek Squad, TVs on the wall. Here's their problem. According to their official company report filed in March, a significant portion of what they sell comes from China or has Chinese components. TVs, laptops, gaming consoles, headphones, smartphones, all heavily dependent on Chinese manufacturing. Right now, Best Buy makes about 23 cents profit on every dollar they sell. That's not much room for error. When the 60% tariff hits, a $500 TV that cost them $385 now costs $616. To keep making the same 23 cents, they'd have to sell that TV for $805. Are you going to pay $805 for a TV? No, nobody will. So what happens? Sales crash. We already saw this exact movie. Back in 2018, when Trump put the first tariffs on China, and those were small, just 10% to 25%, Best Buy's sales growth dropped from 5.6% down to 2.1% in 1 year. And those were baby tariffs compared to what's coming now. We're talking about 60%, triple the impact. Best Buy stock is at $87 today. When their earnings report comes out on March 4th showing sales down 30% to 40%, that stock's going to 55, maybe lower. That's a 37% loss in your retirement account if you own it. And here's what makes this personal. Best Buy isn't just a stock ticker. It's 80,000 American workers, store managers in Des Moines, warehouse workers in Kentucky, Geek Squad techs in Portland. When sales collapse and the stock crashes, Best Buy starts closing stores. They lay off workers. Your neighbor, who's been working there for 15 years, he's gone. Target is facing the same disaster. They get about 40% of their stuff from overseas, and a lot of it comes from China. Clothes, toys, home goods, kitchen stuff. And here's the killer. Target only makes about 6 cents profit on every dollar they sell. 6 cents. When your costs jump 30% because of tariffs and you're only making 6 cents to begin with, you're not making 6 cents anymore. You're losing money on every sale. Now, could Target adjust? Sure, they could shift to more domestic suppliers over time. They could renegotiate contracts. They could change their product mix. But that takes 12 to 18 months, not 90 days. In the short term, they're bleeding. Target stock is at $148 today. When people realize they're operating at a loss in major categories, I think it drops to $110, maybe lower. But here's where it gets really dangerous for your retirement. The worst damage isn't in the stores, it's in technology stocks, and that's where most Americans have most of their money. Apple, the biggest company in the world, the biggest stock in every index fund you own. Here's what most people don't know. According to Apple's own supplier list, about 150 of their 185 major suppliers operate facilities in China, and almost every iPhone, 98% of them, is assembled in China. Let me show you the math on what happens to Apple. An iPhone costs Apple about $558 to make. They sell it for $999. That's a nice fat profit of $441 per phone. That's a 44% margin, which is incredible. But when the 60% tariff hits, that $558 manufacturing cost becomes $893. To make the same profit, Apple would have to charge you $1,194 for an iPhone, $1,594 for a phone. Let me ask you a simple question. Are you going to pay $1,594 for an iPhone when you paid $999 6 months ago? Are you? No, you're not. Nobody is. That's a 60% price increase. People will keep their old phone for another year, or they'll switch to Samsung, or they'll just say, forget it. So Apple has two terrible choices. They can raise the price to $1,594 and watch sales collapse by 30% or 40%. Or they can keep the price at $999 and watch their beautiful 44% profit margin get crushed down to 28%. Either way, their earnings crater. And remember something important. If you own an S&P 500 index fund, Apple is your single biggest holding, about 7% of your entire account. When Apple drops 25%, your whole retirement account drops. Apple stock has already fallen from $195 to $178 since early December. That's 9% gone already, but that's just the beginning. When the earnings report comes out in late April showing iPhone sales down 30%, I think that stock goes to $140, maybe $130. That's another 22% loss on top of what's already happened. Now, Tim Cook is a smart guy. He's already moving some production to India and Vietnam. But you can't relocate the entire iPhone supply chain in 3 months. It took Apple 20 years to build the China operation. It'll take 5 years minimum to rebuild it somewhere else. In the meantime, they're stuck. Now let me show you the car companies, because this is where it gets even uglier. General Motors and Ford don't just get hit with the 10% tax on everything and the 60% tax on Chinese parts. They get slammed with an additional 25% tariff specifically on cars and auto parts. Here's the reality of how cars are made today. According to the Center for Automotive Research, a typical American-made car has about 30% to 40% foreign parts. On a $45,000 pickup truck, that's about $15,000 worth of imported parts. Engines from Mexico, electronics from China, transmissions from Germany, steel from Canada. When you add up all the tariffs, 25% on Mexican parts, 60% on Chinese electronics and computer chips, 10% to 20% on everything else, you're adding about $5,000 to $7,000 to the cost of every single truck. Now here's the problem. GM makes about $3,000 profit on a $45,000 truck. When your costs go up $5,000, that $3,000 profit becomes a $2,000 loss. You're literally losing money on every truck you sell. GM stock is at $42 today. When investors figure out they're selling trucks at a loss, that stock goes to $28, maybe lower. Ford is even worse because the F-150, America's best-selling vehicle for 47 straight years, uses parts from 14 different countries. When tariffs hit all those countries, the math becomes impossible. Ford stock is at $11. I think it tests $7. And here's the part that should scare every American worker. When these car companies start losing money, the first thing they do is cut jobs. According to the Center for Automotive Research, every 10% drop in car production means 15,000 factory workers lose their jobs directly, and another 45,000 people lose jobs in the supply chain, the parts makers, the trucking companies, all of it. We're not talking about a 10% drop. If these tariffs make American cars too expensive to build or too expensive to buy, we're looking at 20% to 30% production cuts. That's 45,000 to 60,000 manufacturing jobs gone. plus another 135,000 to 180,000 jobs in the supply chain. Think about what that means for places like Detroit, for towns in Ohio and Michigan where the auto plant is the biggest employer. When that plant cuts shifts or closes down, the whole town dies. The diner across the street closes, the gas station closes, the housing market collapses. It's not just jobs, it's entire communities. Let me introduce you to someone real. Meet Tom Richardson. He's 58 years old, he's an electrician in Phoenix, makes $68,000 a year. He's got $180,000 in his 401k, his entire life savings. About half of it, $90,000, is in an S&P 500 index fund. That means he owns all these companies I just talked about. Apple, Best Buy, Target, GM, Ford, all of them. If those stocks drop 25% on average over the next 3 months, Tom just lost $22,500. That's 4 months of his salary. That's gone. And Tom's 58. He's got 7 years until retirement. He doesn't have 20 years to wait for it to come back. Tom's wife, Linda, works at Target. She's a department manager making $42,000. If Target starts cutting staff because sales are collapsing, Linda's job is at risk too. So they could be looking at lost savings and lost income at the same time. That's the real human cost of this that nobody's talking about on CNBC. Now, could some of this be less severe than I'm describing? Maybe. If Trump uses these tariff threats as negotiation leverage and backs down, or if companies get exemptions and carve-outs for critical supplies, the damage could be smaller. But do you want to bet your retirement on maybe? Do you want to hope that politicians will suddenly start making smart economic decisions? Here's what I've learned in decades of watching markets. Hope is not a strategy. And here's what really gets me. While your 401k is bleeding, while Tom Richardson is watching his life savings evaporate, the CEOs of these companies will be fine. They've got stock options they can exercise before the crash. They've got golden parachutes worth tens of millions. They've got diversified portfolios and personal financial advisors managing their money. This disaster hits you, the school teacher, the nurse, the electrician, the people who trusted that investing in index funds was safe and smart, the people who did everything right, saved money, contributed to their 401k every month, didn't try to time the market, and now you're about to get crushed by a trade war you didn't vote for and can't control. So here's where we are right now. We're 38 days from January 20th. These tariffs aren't threats. They're scheduled. The implementation dates are set. The percentages are announced. And the stocks I just walked you through, Best Buy, Target, Apple, GM, Ford, these aren't some weird small companies nobody owns. These are the core of every retirement account in America. If you have a 401k, if you have an IRA, if you own any index fund, you own these companies. And over the next 90 days, you're going to watch them drop 15% to 35% as the earnings reports come in and confirm exactly what the math already shows us. Now, I'm not saying panic and sell everything tomorrow morning. That's not smart investing. But here's what you absolutely need to do right now. First, open your 401k statement. Look at what you actually own. If you own target date funds or index funds, look inside them. See how much you have in retail stocks, tech stocks, car stocks. Know your exposure. Most people have no idea what they actually own. They just see Vanguard 2030 fund and assume it's fine. Look at the holdings. Second, ask yourself a hard question. Can you afford to lose 25% to 30% of your tech and retail holdings? If you're 35 years old with 30 years until retirement, maybe you can write it out. If you're 62 and planning to retire in 3 years, a 30% loss might be catastrophic. It could mean working 3 more years. It could mean downsizing your retirement plans. It could mean not being able to help your grandkids with college. Third, talk to a real financial advisor, not your buddy who watches CNBC, not some guy on YouTube, including me, a licensed professional who can look at your specific situation and help you rebalance before the damage hits. Ask them about defensive sectors, ask about bonds, ask about international diversification away from U.S. companies dependent on Chinese supply chains. Ask about companies that actually benefit from these tariffs, domestic manufacturers, U.S. steel producers, American textile companies that have been getting killed by Chinese competition for 20 years. Because here's the thing, nobody's telling you, some companies will win from these tariffs. If you're a U.S. steel mill and suddenly Chinese steel has a 60% tariff, making it way more expensive, Your business is about to boom. If you're a domestic furniture manufacturer competing against cheap Chinese imports, you just got a massive competitive advantage. The question is, are those companies in your portfolio? Probably not. Most index funds are heavy on the globalized tech giants and light on the boring domestic industrial companies. The earnings reports are coming. Best Buy reports on March 4th. Target on March 5th. Apple in late April. When those reports show sales down 30% and profits down 40%, the stocks will gap down 20% before the market even opens. You won't have time to react. It'll be too late. This is not financial advice. I'm showing you publicly available data and basic arithmetic. But you need to understand what's in your account and make informed decisions based on facts, not hope. Now let me tell you what I would be looking at if I were repositioning right now, and I want to be clear. This is educational discussion, not a recommendation. Historically, during trade wars and tariff cycles, three types of assets tend to hold up or even gain. First, U.S. domestic producers who don't rely on imports. Companies that make everything here, source everything here, sell everything here. They're insulated from tariff shocks. Think regional banks, utilities, domestic food producers. Second, treasury bonds and high-quality corporate bonds. When stock markets get volatile and scary, money flows to safety. The U.S. government isn't going bankrupt. Those bonds pay interest regardless of what happens to Apple's stock price. Third, gold and precious metals. Gold has been a store of value for 5,000 years. When people get scared about inflation, about currency wars, about economic chaos, they buy gold. It's not exciting. It doesn't pay dividends, but it doesn't go to zero either. I'm going to do a deep dive on these defensive strategies in my next video, which specific sectors, which types of bonds, how to think about gold allocation. So if you want to see that analysis, subscribe to this channel so you don't miss it. If this analysis helped you see past the political noise and understand the real financial mechanics of what's coming, and let's be honest, you didn't hear this level of detail on CNBC, smash that like button and subscribe. I'm going to keep tracking this situation as it unfolds. The next video breaks down the three things you can buy that actually benefit from tariffs. Don't miss it. The information is all public. The math is straightforward. The only question is whether you're going to act on what the numbers clearly show, or whether you're going to hope that somehow the laws of arithmetic don't apply this time. The tariffs start in 38 days. The earnings reports hit in 82 days. The clock is ticking. Don't let this catch you by surprise. Tom Richardson in Phoenix, he's not waiting. He called his financial advisor yesterday. He's rebalancing his 401k this week. He's moving 40% of his stock allocation into bonds and defensive positions. He might miss some upside if I'm wrong, but he won't lose his retirement if I'm right. What about you? What's your plan? Thank you for watching.